Let's talk about commercial and retail banking brought to you private equity and enabled via tokenization. I'm going to start off with what are the punchlines? What are the main trends to track? Why that matters. So, punchline number one is the connection between the Federal Reserve and the real economy grows more tenuous as private credit, non bank lending, or shadow banking, those are all synonymous terms, grow. Why? Because banks have accounts at the Fed, and the Fed can influence the banks by buying bonds and lowering rates, selling bonds and raising rates, or delivering a higher rate of interest on reserves that banks have at the Fed. KKR, Blackstone, Apollo don't have accounts at the Fed. That's one. So it weakens the relationship between monetary policy and the credit cycle. That has consequences for managing the business cycle. Second, higher rates for small business. So if you want to open up a new pizza shop, barber shop, veterinarian shop, etc., you'll get a better cost of funding than anywhere else by going to a local bank and applying for an SBA loan. So banks are retrenching, their balance sheets are getting smaller, especially the regional banks and the community banks that really focus on small business lending, unlike the giant banks that focus on corporate lending or treasury management. So that's an issue because that will slow the growth rate of the economy and it changes who receives the proceeds of risk taking activity. Lenders start to capture more of that activity as opposed to entrepreneurs and owners. Third is tokenization is playing an incredible role in this, and I'm very excited about tokenization. But tokenization is enabling private equity firms to slowly disintermediate the banks by establishing direct relationships with the LPs, cutting out investment banks, and creating liquidity for LPs. So LPs can earn interest on their deposit at the private credit fund. Now, these are non FDIC insured deposits and obtain liquidity by either financing that interest or selling that interest. And that is also going to reshape how we think about banking, especially for high net worth investors. So the other key punchline here is that banks are taking a back seat, right? So banks are now lending to the lender. Here's a slide that shows what I mean. This slide is from the slide deck of a small community bank, couple $1 billion in assets. And it shows here the various verticals of lending. This is what this particular bank does. You can see the fastest growing category is called sponsor finance MML. That's middle market lending. It's growing at the fastest rate of all these categories. And it's one of the top three categories right alongside SBA general lending and healthcare. You can see it's that top right box. But this trend is going to continue. I expect that next year at this time, this is a bigger bubble and other banks are getting involved as well. So banks are not lending to small business and consumers as much anymore, but they're lending to the lender. And private equity companies and private credit firms have a fiduciary obligation to their shareholders. They do not have a public interest requirement or any Community Reinvestment Act obligation to provide financing in their local community or in the economy. It's interesting because banks will generally lend during a recession, even with lending standards and tightening increasing. These are seismic changes to how credit's extending. It's a continuation of a long trend that started in the aftermath of the 2008 crisis, where the international bank regulator said, gee, these banks took on way too much credit risk, prime mortgages, jumbo mortgages. Let's have a regime that focuses banks on high quality liquid assets, which meant mortgage bonds and treasuries, which created interest rate and duration risk issues. So it's a continuation of that trend. The second is this idea of the KKRs and the Blackstones and the Apollos of the world owning the end customer relationship, cutting out that intermediary of the investment bank. We're going to see that continue. So that's a really notable trend to watch. And it's linked to the growth of alternative investments as an asset class. More generally, we're very excited about that asset class as well. I hope you got those takeaways. Let me walk through Patrick's tweet here, do some translation.
Hmm.
Patrick's a friend. He runs Invenium, which is a tokenization platform. I'm going to share my screen here. He says the role of a bank is changing. Private credit repo markets are developing. So repo market is a lending market. It's a funding market, right? So repos when generally one bank might be a lending to another bank on an overnight basis, a monthly basis, or even like a multi-month basis. So private credit repo markets are developing. What that means is secured financing on your private credit or your LP interest in a fund that's developing. That doesn't exist now. How do you get financing on your private credit investment at Apollo? You don't. That collateral will be resold on tokenized markets. Okay. Private markets will eventually just become markets. So public markets we think of as digital, liquid, they have prices, they have quotation, they transact on exchanges. So what he's saying is that these private markets will start to resemble public markets, and they're enabled via tokenization. The melding of non-bank lending in markets with banks and real-world assets, capital stack. That's, I think, what I was describing before, right? The idea of these community banks providing sponsor finance lending to private credit and private equity. And that will transform banking. Absolutely. The relationship that banks have with the customers is changing. Now, private credit and private equity is going to have more of those direct relationships. And in DeFi lending, you're the next version of capital markets. This goes back to the earlier point that the collateral will be resold on tokenized markets. So imagine you've got a token in Apollo private credit fund, and now you can pledge that to a DeFi protocol and get liquidity on that. So that's the future. So what does that look like? I go on this thread to elaborate. Imagine that you've got a deposit, not technically an FDIC insured deposit, it's a non FDIC insured deposit, but you do have access to liquidity. You're getting a higher rate of return. And that LP position is accruing interest. You can see the accrual and you can sell that position or finance that position using tokenization. So how different is that than a term deposit at a bank, right? Like a certificate of deposit that you have for 3 months, 6 months, or a year. It's not very different at all. In fact, it's not really different even from a demand deposit. Now, the key difference here is the lack of FDIC insurance. But is it really hard to imagine where this goes next? I mean, you could tranche out that private credit interest and have a senior bond that can fetch an investment grade rating. And if it achieves an investment grade rating, it can be insured. And now you're receiving commercially insured rate of return from a private credit fund that has now effectively played the role of a bank, both in deposit gathering and credit extension. So that may well be the future, folks. Hope you enjoyed. Take care.